This content is for educational purposes only and is not financial advice. Any results shown are illustrative, not a promise or guarantee of similar outcomes, and individual results vary. Options trading involves high risk of loss.
Hello, in today's video we'll be taking a look at the Tuesday, June 30th, 2026 trading session for the SPX CBOE index. We'll be utilizing three different indicators. First, the SPX daily key levels V3.0 indicator. Second, the VWAP for SPX CBOE. And then lastly, the ribbon V3.0 multi-reset indicator, which is our newest version of our ribbon indicator. Okay, so in today's session, we have a close above the bull bear key price level on the opening candle. We have our ribbon indicator set to session reset at the 9:30 a.m. RTH session open. So it's giving us a clean read from the open. We're not really getting an entry until the 9:44 a.m. candle here, which that is when the ribbon is all green. The upper bands of the ribbon are starting to pull away from the base of the ribbon. So we have still our close above the bull bear key price level for today. We have our ribbon confirmation for that entry on the close above the bull bear key price level here. Back here, the bands of the ribbon are still fairly compressed. So right here is the entry at 9:44 when the upper bands of the all green ribbon start to pull away from the base. The standard play on this particular entry is going to be the call option closest to today's bull bear KPL level of 74.3886. So that is going to be the 74.40 call option. The ask price on the candle close of the 9:44 a.m. candle is $23.60. We're also going to take a look at the early session lotto option trade. So we're going to explain the difference in the strikes as well. With this particular indicator in the daily key level strategy, in the standard strategy, there are three different option strikes that you can choose from. The standard play of those three is going to be the strike closest to the level that you're basing the trade on. In this case, a bullish trade taken off the SPX bull bear KPL. So that's going to be the strike closest to this, which is the 74.40 call option. The next out of the money option that you can consider, which is not our early session lotto option strategy, these are the two other out of the money strikes you can consider in the standard strategy, are going to be the strike closest to the first midpoint above. So that's 74.5104. So that would be the 74.50 strike. Lastly, the final out of the money option on the standard option strategy is going to be the strike closest to one full level away from the level that you're basing the trade on. That is the R1 level for today, 74.6321. So that's going to be the 74.65 strike. We're not going to look at those two strikes today. We're simply going to go to the extreme of the lotto option plays next. As far as stop losses on the trade, you can either use the tight stop loss, which is the QL level below the level that you're taking the bullish trade on. So in this case, that would be the QL below BBKPL. The standard stop loss is the first midpoint below the level that you're basing the trade on. In this case, the mid BBKPL S1, which is this level here. As you can see in either case, neither stop loss was close to being breached in this particular trade. Now we also have our VWAP indicator here. So the VWAP itself is this light blue line here. These are the upper bands of the VWAP and these are the lower bands of the VWAP. Now you may be asking yourself, why do we need a special VWAP indicator for trading view for SPX CBOE? And this also applies to the mini index XSP, which is the symbol for the mini SPX index. And the reason why is because the native VWAP indicators for TradingView do not work on either of the symbols, the regular official SPX CBOE index or the XSP official SPX mini index. So I'll go ahead and show you that now. We'll move these down out of the way. We're just going to go ahead, go down to technicals that are built into TradingView. We'll go down to the volume weighted average price. And now we'll go to VWAP auto anchored. So as you can see here, we'll go ahead and we'll turn off our VWAP, or we'll hide it for the moment. So we've added these two VWAPs that are native VWAPs, technical indicators built into TradingView. As you can see, they both have red exclamation points, and that's because there's no volume data. And that is not a TradingView problem, it's a global indices feed situation with TradingView with the CBOE global indices, as the data feed from CBOE does not provide volume data, and of course you need volume data in order to have a VWAP. So as you can see here, that's why you have the red exclamation points, and that's why there's no VWAP. Our VWAP uses an external institutional data source. So we'll turn it back on, and now you have VWAP. So this way you don't have to open up a second chart and just use SPY or another S&P 500 instrument with a VWAP on it. You can simply just have your VWAP directly on your SPX or XSP chart. All right, so we'll go ahead and move these out of the way now. As you can see here, we're also above the VWAP on this 9:44 a.m. close. So that's an additional confirmation. However, the main entry signal is going to be your close above a main key level or a contextual level. In this case, the bull bear KPL. However, with this indicator, you could also choose to either use the YDH or the YDC level, the two contextual levels, as it is also closing above those levels and also has the ribbon confirmation. So the candle close above the main key level or contextual level is your initial entry signal. However, we need confirmation. We're not just going on a candle close above for a bullish or a candle close below for a bearish. We also need confirmation from the ribbon. Ideally, you would also like to have confirmation from the VWAP, although that's not completely necessary, as the ribbon is actually more important than the VWAP. So you cannot have, for confirmation, you cannot have a multicolored ribbon. You need to have an all green ribbon for confirmation of a bullish entry on a close above a main key level or contextual level, or conversely, for a candle close below a main key level or a contextual level. For a bearish entry, you need the opposite. You need a all red ribbon with the lower red bands pulling away lower from the base of the all red ribbon. Okay, so here again we have the candle close on the 9:44 a.m. candle. We're on a 2-minute chart. You can use either a 1-minute, 2-minute, 3-minute, or 5-minute chart with this strategy. In either case, you're still looking for candle closes above or below a main key level or a contextual level. The contextual levels are the pre-market high, the PMH, the PML, pre-market low, YDH, yesterday's daily high, YDL, yesterday's daily low, and YDC, yesterday's daily close. Now, if you're taking a trade off of one of the 5 contextual levels, then you simply go into the user control panel, go down to that trading section, stop loss and take profit levels for the contextual levels. If you're taking a bullish entry, you look for the contextual level that you want to take the trade off of. For example, let's say in this case, we were wanting to take a trade off of YDH. Simply go down to YDH, click Enable Bullish Entry Stop Loss. You can either leave it at standard or tight. So for example, if we did standard, we would also enable the bullish entry take profit. Standard is going to be a 2-to-1 risk to reward. So $2 of profit for each $2 of profit for each $0.1 of risk. You can also go all the way up to 30. So for example, if we went on a 4-to-1 here, you can go below 2 as well. They're in 0.25 increments. We're on the wrong one here. My apologies. YDH. It's like I need my additional cup of coffee here. Okay, so we have YDH, bullish entry, standard stop loss, 4-to-1. Here's your standard stop loss here if you're taking the YDH entry. Here's your 4-to-1 risk to reward. Now you can move this down if you want to target, say, either R1 or mid R1, R2. So for example, you could also change the stop loss to tight if you wanted to. So we'll just take a look at that. First, let's just change this to tight. Still leave it on a 4-to-1. Okay, so here's the tight stop loss for that right here. You can also increase the font size on these. So if you go down to that section, go up to the top here, you can make them large. So this is the stop loss, take profit line label text size, which you can change. So as you can see here, we've changed it to large now, so it's easier to see. And here's your 4-to-1. So moving it up to 4.25 or 4.50 on a tight stop loss puts you at approximately the mid R1, R2. Moving it down 3.75 or 3.50 would put you here at the R1. Increasing it more would put you at R2. So it really just depends. If you want to go with the standard 2 level, then you can simply just go down, change it back to the default, and let's say you were going with the standard stop loss. Standard stop loss 2-to-1 ratio puts you here. That's if you're going to do the trade off the YDH. When you're basing trades off of the main key levels are the bull bear KPL, R1 through R6 above, S1 through S6 below. Now we don't have all of the levels here because if you do that, then your screen is going to look more like this. So if price starts going in one direction and starts exploding up or down, then you can simply move your chart. You simply go over here to the price axis, left click and hold and move it out. Generally speaking, you want to keep your chart at the open between R3 and S3 or R2 and S2, as 80 to 85 sessions are primarily going to be contained in a normal volatility environment between R2 and S2, so a two-level extension away from the bull bear KPL. So if you're going with that, then you would expand it out R2 to S2. So 80 to 85%, 80 to 85% of SPX sessions in a normal year in a normal volatility environment or moderate volatility are going to be contained within a two-level extension away from the SPX bull bear KPL. That would be R2 down to S2. In the remaining minority 15 to 20% of the sessions, the majority of that remaining 15 to 20% is going to be lower volatility mean reverting sessions that will generally stay contained within R1 down to S1, and then the smaller portion of that remaining 15 to 20% are going to be high to extreme volatility sessions, which are going to be above R3 to R6 and below S3 to S6. Okay, so now let's take a look at the stop losses again. So on main key levels, bull bear KPL or R1 through R6 or S1 through S6, if you're taking bullish trades off of any of those levels, the QL below is your tight stop loss. The midpoint below, the first one, is your standard stop loss. On these midpoint levels and QL levels, you just simply go into the user control panel. And for example, if we were taking a trade off of S1 or R1, QL below S1, QL below R1. So as an example, if we were taking a bullish trade off of R1, our tight stop loss would be QL below R1, and our standard stop loss would be the first midpoint below. If we had a different sort of day where we were going down and then curling back up, and we had close above S1 with ribbon confirmation all green, upper bands moving away, and there was entry opportunity on S1 for a bullish trade off based off of S1, then your tight stop loss is QL below S1, and then your standard stop loss is going to be first midpoint below mid S1, S2. Now you can turn on many different levels to begin with and save that as the default. So if you prefer to have all the QL levels turned on, let's say between R2 and S2 and all the midpoints, then you just simply enable them and save them as your specific default. The default on startup is just going to have the main key levels, the contextual levels, as well as the QL above and below the BBKPL, and the midpoints above and below the BBKPL, as those are the most prevalent at the start of a session. So it's just really up for each user to decide when you're using the indicator what preferred look of which levels that you like to have enabled on startup as your default display, and then you simply just save that as the default. Okay, let's go ahead and we'll just turn off Okay, so what about take profit targets and trade adjustments with trades off the main key levels? So as the case today, bull bear key price level. With the standard options trading strategy, there are going to be a couple of different targets depending on what your objective is. So with this particular strategy, there are two different types of scalp trades that you can do. Your regular scalp trade is going to be a one level move calculated from the level that you're basing the trade on in the direction of the trade. So that would be R1. So if you just want to do a scalp trade, the target is R1, one full level away. Now, a micro scalp trade would be a contextual level that is far enough away from the level that you're basing the trade on, but occurs before the regular scalp one level move. So in that case for today, that would be the PMH level. So micro scalp would just be a hit of the PMH level. Regular scalp, the R1 level. If this PMH was down here and very close to the bull bear KPL, then there would just be no micro scalp available because there would be no contextual level far enough away, but still below R1. So that's how you decide on that. Now, on a regular day trade, there's two different targets. One is a 1.5 level move, which is the minimum required move for a regular trade. So the minimum threshold is going to be a 1.5 level move. 1.5 level move is the mid R1, R2 from the BBKPL. So this is one level, next midpoint above, 1.5 level. The minimum ideal move is the R2 level for a bullish trade based off the bull bear KPL because it's a two level move up to R2. Why is that the ideal move? Well, we go back to the two level extension above and below the bull bear KPL, where prices contained 80 to 85% of the sessions in a regular trading year in a regular moderate to regular volatility environment. A two level move can mean either a trade from the BBKPL up to R2. Bearish trade down to S2 can also mean S1 up to R1 on a bullish trade from R1. Conversely, bearish trade R1 down to S1. Or bearish trade from R2 down to BBKPL, bullish trade on S2 up to bull bear KPL. Because, as we said, 80 to 85% of the sessions in a normal year in a normal volatility environment are going to be contained within this range R2 down to S2 and 80 to 85% of sessions. Now at any one of those targets, you can do one of several things in this strategy. You can either just exit 100% of your position, whether you're doing a scalp, regular scalp, micro scalp, regular trade 1.5 level move, or a 2 level move, 100% exit. The second thing is that you can adjust your stop loss to break even. Now we start off with a level-based stop loss. If you're going to adjust your stop loss to break even or break even plus an additional profit buffer on top of break even, then what that means is that you are instead changing your stop loss to a price-based stop loss, moving it to the price that you paid on your executed entry. So in this case, for this particular 70/40 call option, when price is hitting either micro scalp here, regular scalp here, or this level here, or if it reaches this level here, changing your stop loss from a level-based stop loss to now changing it to at least 2360, which was the executed price. If you're going to add an additional profit buffer, then you make it something greater than 2360, such as, say, 25. Roughly 10 to 15% is a good additional profit buffer to give some leeway and some room for the trade to still breathe. The third option is only applicable if you're trading 3 or more contracts, and that is going to be where you are doing a combination of exiting contracts on one of these targets, as well as keeping remaining runners on the contracts that are left, adjusting your stop loss to break even or break even plus an additional profit buffer on those remaining runners. So for example, if you're trading 3 contracts, then when it hits either the micro scalp, the 1 level regular scalp R1, or on a regular trade, the 1.5 level or 2 level move, you're exiting and closing out 60 to 90% of your contracts. So in the case of 3, that would be 2. Collecting that profit, securing that profit, and then on the remaining contract, you're adjusting your stop loss to break even, the price you paid on the executed entry, or break even plus an additional profit buffer. Then what you're looking for is to see if this is going to be a session where you get an extended move from your target. When it moves up to an additional target, then you can either exit those runners or further adjust the stop loss on the runners by adding more profit buffer by adjusting your stop loss higher, then seeing if it will go up to the next level above in the case of a bullish trade. Obviously, in a bearish trade, it'd be the opposite. You're looking for additional level moves down. If you're trading more than 3, for example, if you're trading 4 contracts, then closing out 3 would be 75%. So it's generally 60 to 90%. So it really depends how many contracts you start out with. If you started out with 5, then if you exited 3, that's 60%. If you exited 4 out of the 5, that's 80%. If you're trading 10 contracts, then exiting 6 is 60%, exiting 7 of them is 70, exiting 8 is 80%, and exiting 9 is 90%. So it just really depends on the amount of contracts you're doing. Okay, so here we're just going to look today at the regular scalp and the regular trade 1.5 level move. Regular scalp move to R1. That happens here on this 9:54 a.m. candle. We have the hit here. The bid on the close of this candle, $32.60. So that's $900 profit per option on the scalp. Again, you're either exiting 100% of your position here, or you are adjusting your stop loss to break even, or break even plus a profit buffer, or you're doing, if you have multiple contracts, exiting 60 to 90%, securing the profit here, then adjusting your stop loss to break even on the remaining runners, moves up to another level, then you can either exit 100% of the remaining runners or further adjust your stop loss by adding more profit buffer. If you're using regular trade as an initial target, 1.5 level minimum threshold move is to R1, R2. Happens here on this candle, the 10:30 a.m. candle here. The bid on the close of that candle, 42.20. That's $1,860 profit per option. All right, well now we'll take a look at the early session lotto options. Okay, early session lotto option strategy. We also have a late session lotto option strategy, which is completely different than what we're about to show you. In the description of this video, there'll be a link to a video that goes over the late session lotto option strategy as well. It's a little bit different. The late session lotto option strategy is for the window starting at 2 p.m. and runs as far as entries to 3:45 p.m. And that is only going to be a strategy that you would use for taking a portion, a small portion of your accumulated profits for the session, actually a max of 10% of any profits you have in the current session for a late session lotto option play. So it's a little different strategy for late session as opposed to early session. The early session lotto option strategy is an alternative to just doing the standard daily key levels option strategy, which we showed you earlier, which was either using the standard play strike closest to the level that you're basing the trade on, or the strike closest to the midpoint level above, or the one level above as your two out of the monies. Those are all in the standard option strategy. One being the standard play that strike closest to, and then the two out of the monies. The early session lotto option strategy, though, is different because it's using the strikes for the regular trade targets. So that's going to be the strike closest to the 1.5 level target and the 2 level target. So in this case, for today's session, on a bullish trade based on the bull bear KPL, the 1.5 level target mid R1 R2, that's 74.7538. So that's a 74.75 strike is going to be your first lotto option one to consider. The furthest away is going to be the strike closest to the R2 level. It's a 2 level away from the level that we're basing the bullish trade on. 74.87, 74.8755, so that's a 74.90 strike. So we look here and we have on the same 9:44 a.m. candle right here. Everything's the same as far as entry, confirmation, tight stop loss, standard stop loss. The difference is going to be, of course, the cost that you're paying for early session lotto option. Now, the reason it's called early session lotto option strategy is because this is for moves that are going to occur in the early session. So you generally want to be out of these trades sometime in the morning session as well before lunch. So if price is not moving, you don't want to be holding on to these options, say after 12 noon starts. So if price starts not hitting your stop loss, but it's also not going anywhere, and it's just sort of moving sideways, then you don't really want to hang on to these going into the afternoon session. So as you can see here, there's quite a price difference. Here we have the 74.75 call option. The price is $7 on the entry. The 74.90 is $3.40. Compare that to the standard play. Remember, the standard play was $23.60 for that entry. So there's quite a difference in the cost. The other thing is that with the early session lotto option strategy, there is one more stop loss option that you have available to you that you're not going to have using one of these standard option strategy strikes that you are using here. So either the one, the R1, midpoint level, or this level. So when you're using these, you do not have this particular other alternative stop loss option available to you, mainly because of the cost of these. Now this other stop loss option, remember that you still have the same stop losses that we were talking about. So tight stop loss and standard stop loss. That still applies to these early session lotto options. So those would be your tight and standard stop losses, the same as if you were using the other strikes. However, there is a third option for stop loss with early session lotto option plays, and it really just depends on the cost of the option. This particular stop loss option alternative would only apply generally if you are looking at an option that is around $5 or less. So the third option is that you can use no stop loss. And your stop loss is really just the amount of money that you're putting into the trade. So in this case, that would be this option here, $3.40. So if this option just completely fizzles out in the early morning session, let's say we get a reversal, and you were utilizing this particular alternative stop loss strategy, then you have a total of $340 at risk. As opposed to if it goes back down to the QL or midpoint level in the early part of the session, then obviously it's going to be worth more than zero if you're using these stop losses. We're just telling you this not as a recommendation to use the no stop loss as the third option, just making you aware that it is available as an alternative, just depending on the price of the option that you're paying. And if you're going to use no stop loss, then you just have to be aware of the fact that the total amount that you're paying is actually going to be basically your stop. That's the total amount of risk. Whereas if you're using the stop loss here, let's say this reverse back down, then this is still going to be worth something, and obviously this is going to as well. Okay, so we're going to look at the differences between the scalp level and regular trade 1.5 level moves, and look at the profits versus the entry cost on this in comparison to the standard options play, which we looked at earlier, which was using this strike and having an entry cost of $23.60. Here we have an entry cost of $7. Here we have an entry cost of $3.40. Now, when it hits R1 here on the 9:54 a.m. candle, the 74.75, which you paid 7 for, is now a bid at 11, so that's a profit of $400 per option. But you only put in $700, so percentage-wise, that's still a very good gain for that. Same thing here. Cost $3.40. Bid price on the close on the scalp $5.70, so that's $230 profit per option. So percentage wise, this is a very good return on either one of these, even though the actual profit dollar figures are a lot less than the regular standard play, which we'll go back and look at now. Okay, so as you can see over here, we have the other one here, entry 2360 on a scalp, $900 profit, bid 3260, regular trade 1.5 level move, 4220, 1860, but we had to put in $2,360. So we're earning a lot more here, however, we have a lot more here to put in to initiate the trade. Here on the 1.5 level move on the early session Lotto options, remember that's the 10:30 candle here. As you can see, we're finally making it up to R2 here. So again, 2-level move, 80 to 85% of the sessions, 2-level extension above and below R2 down to S2 is the range in 80 to 85% of the sessions. Okay, so here at the 10:30 candle, $15.20. Remember, we had $7 putting in. That's $820 profit per option on that one. 74.90 is now $7.40 on the bid here on this. And we only put in $3.40, so that's $400 profit per option. So $400 and $820 versus $1860, but you have to remember you were either only putting in $700 or $340 per option here. Here you're putting $2,360 per option here. So with this, remember that with this particular play, if it goes back down and hits the tight stop loss or standard stop loss, you're going to have a loss probably somewhere between, on the tight stop loss, maybe $500 to $600. On the standard stop loss, more like roughly $900 up to $1,100 or so. It's going to vary on every day depending on the volatility. On extreme or high volatility days, the options will cost a lot more. However, the loss will be generally less because of the extreme or elevated volatility. However, if the volatility starts compressing after starting out high, then that could change things significantly. And the losses could be more than that if it does end up compressing quite a bit after the open. So it really just depends. That's why we use levels only as the initial stop loss because those are more consistent to deal with rather than just going with a straight percentage or a cost of the option on the option strategy as far as the tight stop loss and standard stop loss. Remember, you're switching to a price-based stop loss and cost of the option-based stop loss when you're hitting your targets and adjusting your stop loss to break even or break even plus a profit buffer. Now, if you find the standard play or the other standard out of the money options on the standard strategy, the midpoint 74.50 or 74.65 for today, to still be too expensive for the potential risk, then that's why you can consider using the early session lotto options play because your cost is going to be a lot less. If it hits the stop loss, we'll just go ahead and move these out of the way now. If it hits your stop loss early on in the session, then you're going to have a very moderate, at least from a dollar amount perspective, loss on either one of these because you're not putting as much money in to begin with. So it really just depends on what you're really looking for. Obviously with these two, another advantage of these is if you're going to put the same amount of money in 2360, then you could buy 3 of these and you could buy, say, 7 of these with the same amount of money. So it really just depends on what your total objective is and how much money that you want to have at risk, and then also the amount that you'd like to make. Obviously, with something like the standard play, you're going to make a lot more on the same move as far as dollar amount. So we go back to that again. Putting in 2360 per option. One scalp, one level move, you're making $900 profit per option. Regular trade, 1.5 level move, $1,860 profit per option. Obviously, when we get up here to R2, R2 is about 12 points more away. So on this particular one, it's going to be a lot more in the money the further it goes away because we're starting off with a 74.40 option. So here you're probably looking at about $48 to $50 here. So now you'd be up approximately another $800 or so on this one, now to 2,600, 2,700, maybe 2,800 here on this spike. Obviously, these are gaining too on this here, mainly because it's now 12:05. So this would be the time to get out on early session lotto options, regardless of what was going on, even if this was just kind of fizzing around and you hadn't gotten out yet, because you don't want to be holding on to these after 12 p.m. Okay, so that's going to wrap it up for today's video. If you are interested in purchasing the SPX Daily Key Levels V3.0 indicator, like I said, we do have additional videos that you can watch that are in the description of this video, other links. If you'd like to watch some expanded sessions and we go into more detail about the indicator, some of the other aspects of the indicator and features of it, as well as in some of the other videos, we go over the late session lotto option strategy. The late session lotto option strategy, just to just tell you a little bit about it, is from the window starting at 2 p.m. and as far as any entries runs to 3:45 p.m. In that case, you're taking a maximum of 10% of your accumulated profits for the session to consider for any lotto option, late session lotto option play. And you're only using a max of 10%. So let's say you had made $2,000 profit. So you would have an allocation of up to $200 for a late session lotto option play. Generally, the late session lotto options, you're looking for options that are in the 25-cent, 50-cent, 75-cent, dollar, $1.25, $2 range. And there are different sets of circumstances of what you're looking for in entries later on in the session. But generally, you're confining your entries to a lot lower priced entries. At that time, from 2 p.m. to 3:45, as time moves on, the cost of the options is going to be a lot cheaper. So we go over that strategy in some of our other videos. It's a little bit different than the early session lotto option strategy. And it's meant to take a chance on late session plays, but it's only if you have profits in order to take a max of 10% of those profits. That way, if the late session lotto option play fizzles out, goes nowhere, and you lose money on it, you still have at least 90% of your accumulated profits for that session to go home with for that day. But we're not going to go into any more of that. You can simply watch one of the other videos that'll be in the description of this video if you'd like to move that. If you would like to purchase this indicator, the SPX Daily Key Levels V3.0 indicator, we currently offer a discount promo code on it. If you want to get the discount promo code on it, just simply send us an email at daytradinggps@gmail.com to request a discount promo code. Now, if you'd like the SPX suite, that includes all three indicators here, the SPX Daily Key Levels V3.0, the VWAP for SPX and XSP, and the newest version of our ribbon indicator, the ribbon V3.0. This ribbon not only has resets for indexes, but also for stocks, ETFs, futures, forex, and any global market. All right, so thank you again for taking your time for watching today's video. We appreciate you taking the time to do so. If you did like the video, please hit the like button as that helps us with the YouTube algorithm. If you'd like to be notified when we post videos on any other trading topic, you can hit the subscribe button and you'll be notified when we post new videos. So again, thank you for taking your time for watching today's video, and we wish you much prosperity in all your future trading. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.